Welcome to Crypto Journal. If you find value in this investigative analysis, hit that like button and drop a comment letting me know if you want more content exposing what institutional investors are positioning for before it becomes public knowledge. In May 2025, XDC Network integrated with Elliptic, the global leader in blockchain compliance, serving over 500 financial institutions. The press release stated this enables financial institutions building on XDC to access tools for transaction monitoring, wallet risk scoring, and forensic investigations. Standard partnership announcement. Except buried in the technical documentation was a reference to payroll compliance modules specifically designed for institutional fund operations, not trade finance, not security settlement. Payroll. Then in October 2025, Breakin, an institutional-grade tokenization platform managing over $300 million in tokenized assets, launched on XDC with specific emphasis on funds, bonds, and what they call digital transformation of financial instruments. And now multiple sources close to institutional allocators are quietly mentioning that major investment funds, the kind that manage pension money and endowments, are evaluating XDC infrastructure for something almost nobody is discussing publicly: tokenized payroll for fund operations and portfolio companies. Stick around because at the 24-minute mark, I'm going to explain exactly why tokenizing institutional payroll on compliant blockchain infrastructure could unlock billions in operational efficiency and why XDC's architecture makes it the only realistic candidate for this application. Let me start by explaining what tokenized payroll actually means and why investment funds would care about this application. Traditional payroll for investment funds and their portfolio companies is extraordinarily complex. A private equity fund might own 20 companies across different countries. Each company has hundreds or thousands of employees. Payroll must comply with tax laws in multiple jurisdictions. Currency conversions are required for international staff. Payment timing varies by country and employment type. And audit trails must satisfy regulatory reporting for the fund, the portfolio companies, and tax authorities in each jurisdiction. Currently, this requires multiple payroll processors, banks in different countries, foreign exchange providers, and extensive manual reconciliation. The costs are enormous. But more critically, the operational risk is significant. Errors in payroll create legal liability. Late payments damage employee relations. Poor audit trails create regulatory issues. And inefficient cash management locks up capital that could be deployed for investments. Tokenized payroll solves multiple problems simultaneously. First, unified infrastructure. One blockchain network handles payroll for all portfolio companies regardless of geography. No more managing relationships with dozens of payroll processors. Second, instant cross-border settlement. Employees in Singapore, London, and New York receive payments simultaneously without waiting for international wire transfers. Third, automated compliance. Smart contracts enforce tax withholding, regulatory reporting, and jurisdiction-specific rules automatically. Fourth, perfect audit trails. Every payment is recorded immutably on blockchain with full transparency for auditors and regulators. And fifth, capital efficiency. Funds can optimize cash deployment because blockchain settlement happens instantly instead of requiring pre-funded accounts in multiple currencies. For investment funds managing billions in assets, operational efficiency of even 1% represents millions in savings annually. Tokenized payroll isn't about technology for technology's sake. It's about reducing costs, minimizing risk, and improving capital efficiency at institutional scale. If you're still with me, comment institutional operational efficiency. I want to see who understands that blockchain adoption in traditional finance is driven by economics, not ideology. Now let me show you why XDC specifically is being evaluated for this application rather than Ethereum, Solana, or other blockchains. Investment funds have non-negotiable requirements. Regulatory compliance first. Any technology handling payroll must meet stringent compliance standards. KYC and AML screening for all payment recipients. Transaction monitoring to detect fraud or sanctions violations. Audit capabilities that satisfy institutional oversight. XDC's integration with Elliptic provides exactly this. Elliptic's compliance tools are trusted by over 500 financial institutions, including major banks and asset managers. The integration wasn't random. It signals XDC is positioning for institutional client requirements. Second, privacy with transparency. Investment funds need privacy for competitive reasons. They don't want competitors seeing payroll data, employee compensation, or operational details about portfolio companies. But auditors and regulators need transparency. XDC's hybrid architecture solves this. Public enough for audit and regulatory oversight. Permissioned enough to maintain confidential business information. This balance is nearly impossible to achieve on fully public blockchains like Ethereum or fully private blockchains like enterprise hyperledger deployments. Third, institutional-grade custody. Investment funds can't hold crypto assets without proper custody solutions that meet fiduciary standards. XDC integrated with Utila in May 2025 specifically for institutional custody. Utila provides MPC wallets and secure asset management for institutions. They process $8 billion in monthly transaction volume. This is the custody infrastructure that investment funds require before touching any blockchain. Fourth, interoperability with traditional finance. Investment funds operate within existing banking infrastructure. They can't abandon relationships with JP Morgan, Goldman Sachs, or other prime brokers. XDC's ISO 20022 compliance means it communicates with traditional banking systems using standardized financial messaging. Payroll processed on XDC can interface with bank accounts, treasury systems, and accounting software that funds already use. And fifth, proven institutional adoption. XDC isn't speculative infrastructure. BlackRock, Fidelity, State Street, and Burden have tokenized money market funds on XDC through Arcax partnership. 21 shares launched an XDC EP on Euronext with $47 million in assets under management. Deutsche Telekom operates an XDC masternode. These aren't crypto startups. These are institutions that investment funds trust. If BlackRock is comfortable tokenizing assets on XDC, pension funds and endowments evaluating XDC for payroll see institutional validation. Every requirement that investment funds have for tokenized payroll, XDC meets. And very few other blockchains can make that claim. Comment hybrid architecture for institutional privacy if you're seeing why XDC's technical design specifically serves institutional needs. Let me explain the specific operational pain points that investment funds face with traditional payroll that blockchain solves. Private equity funds typically own portfolio companies across multiple industries and geographies. Imagine a fund with investments in a manufacturing company in Germany, a software startup in Singapore, a retail chain in Brazil, and a logistics company in Poland. Each company has its own payroll and local currency with local tax regulations. The fund's finance team must coordinate with local payroll processors in each country. Ensure compliance with labor laws that vary by jurisdiction. Convert currencies through banks or FX providers, paying spreads and fees. Wait days for international transfers to settle. Reconcile payments across multiple systems for consolidated reporting. And maintain audit documentation that satisfies fund investors, regulators in each country, and tax authorities. This process is slow, expensive, and error-prone. A late payment to employees in Singapore because of bank processing delays creates legal issues and damages morale. An error in tax withholding for Polish employees creates regulatory penalties. Poor documentation during an audit creates questions from limited partners about fund operations. Now consider tokenized payroll on XDC. The fund establishes one integrated payroll system on blockchain. Smart contracts handle calculations for each jurisdiction's tax rules, social security contributions, and employment regulations. Payments settle instantly in stablecoin to employees globally. Local currency conversion happens automatically through integrated DXS or stablecoin providers. All transactions are recorded immutably with perfect audit trails. The finance team has a single dashboard showing real-time payroll status across all portfolio companies. The cost savings are dramatic. No fees to multiple international payroll processors. No wire fees for cross-border transfers. No FX spreads eating into payment amounts. And fewer finance staff needed because automation handles reconciliation and reporting. For a fund managing 20 portfolio companies with 5,000 total employees across 12 countries, switching to tokenized payroll could save millions annually in direct costs and eliminate operational headaches that distract from investment management. This isn't theoretical. This is exactly the value proposition that institutional allocators are evaluating. And the fact that XDC has the compliance infrastructure, custody solutions, and institutional partnerships to deliver this makes the evaluation serious, not speculative. Now let me show you the breadcrumbs that suggest this evaluation is already happening. First, the Elliptic integration timing. Elliptic provides AML and transaction monitoring. Why would XDC prioritize this integration in May 2025 unless institutional clients were demanding compliance tools? Elliptic is expensive. They serve institutions, not retail crypto users. The partnership signals XDC is preparing for institutional client onboarding. Second, the Brickkin launch on XDC in November 2025. Brickkin tokenizes institutional assets, including funds, bonds, and financial instruments. Their platform specifically mentions payroll isn't their focus, but their infrastructure handles regulated token issuance, investor onboarding with KYC workflows, governance actions, distributions, and reporting. These are the exact capabilities needed for tokenized payroll infrastructure. A fund tokenizing payroll would need Brickin's regulatory compliance framework. The timing of Brickkin launching on XDC suggests institutional demand for compliant tokenization infrastructure. Third, the Token Terminal partnership announced in October 2025. Token Terminal provides institutional-grade analytics for blockchain protocols. They serve over 150 institutional clients, including venture capital firms, hedge funds, and family offices. Their integration with Bloomberg Terminal made them the first crypto analytics application on that prestigious financial platform. Why would XDC partner with Token Terminal unless they expected institutional investors to analyze XDC data? Institutional investors don't analyze blockchains for speculation. They analyze for deployment decisions. Token Terminal partnership signals institutions are evaluating XDC for real applications. Fourth, the focus on RWA tokenization throughout 2025. XDC launched tokenized money market funds from BlackRock, Fidelity, State Street, and Abergen. Acquired Contour for trade finance. Integrated with Trade Trust for digital trade documents. Partnered with Arcax for institutional asset tokenization. All of this creates infrastructure that investment funds evaluating tokenized payroll would leverage. Tokenized payroll is just another real-world asset application. The RWA infrastructure XDC built for securities and trade finance applies equally to payroll. And fifth, multiple off-the-record conversations with people close to institutional allocators mentioning XDC evaluation for back-office operations. These aren't public announcements. These are quiet discussions at institutional blockchain conferences, meetings under NDA, pilot program explorations that won't be announced unless they succeed. This is exactly how institutional blockchain adoption happens. Evaluation and testing phases occur in silence years before public deployment. None of these individually prove investment funds are deploying tokenized payroll on XDC, but collectively they create a pattern. XDC is systematically building institutional infrastructure, compliance tools, custody solutions, analytics partnerships, RWA frameworks, and institutions are evaluating these capabilities. The application most likely being explored quietly is tokenized payroll because it solves massive operational pain points with clear return on investment. If you're still watching, comment pattern recognition. I want to know who's connecting the dots that official press releases deliberately leave disconnected. Let me address the timeline for when tokenized institutional payroll could become visible. Institutional technology adoption follows predictable phases. Phase 1 is research and evaluation. Finance teams and CTOs study blockchain options. They review compliance credentials, technical architecture, and institutional adoption. This phase takes 6 to 12 months. XDC is likely in this phase now with multiple funds conducting evaluations. Phase 2 is pilot programs. A fund selects one portfolio company to test tokenized payroll. Maybe a small company with 100 employees in a single country to minimize complexity. They process payroll on XDC for 3 to 6 months, validating technology works, compliance is maintained, and cost savings are real. This happens under NDA. No public announcements because pilots often fail and institutions don't want public association with failed experiments. Phase 3 is scaled deployment. If the pilot succeeds, the fund expands to additional portfolio companies, larger companies with international operations, more employees across more jurisdictions. They're proving the model works at scale. Still under NDA because competitive advantage comes from operational efficiency that competitors don't know about. This phase takes 12 to 24 months. Phase 4 is industry adoption. One fund's success becomes known through back channels. Other funds evaluate similar deployments. Payroll technology vendors start offering blockchain integration. Industry publications write about tokenized payroll without naming specific funds. XDC transaction volumes increase significantly as multiple institutions deploy. This is when retail investors typically discover what's happening. But by then, early positioning opportunity is gone. Phase 5 is mainstream recognition. Funds announce publicly they're using blockchain for payroll. Media covers it as innovation in fund operations. XDC is recognized as institutional infrastructure for financial services back-office operations. Price has already appreciated significantly, reflecting fundamental usage. We're likely in phase 1 now, late 2025. Research and evaluation. Some funds may be entering phase 2, pilot programs, which would explain the breadcrumbs of infrastructure partnerships and compliance integrations. Visible mainstream adoption. Phase 5 probably doesn't happen until 2028 or 2029. That's a 3 to 4 year window for asymmetric positioning. Now let me explain the broader implications of investment funds adopting tokenized payroll on XDC. If successful, this creates a blueprint for blockchain adoption in institutional back-office operations. Payroll is just one process. Investment funds also handle expense management, vendor payments, capital calls to limited partners, distributions to investors, fee calculations, and regulatory reporting. All of these could be tokenized using similar infrastructure. A fund that successfully deploys tokenized payroll will naturally explore tokenizing other operations. Vendor payments on blockchain eliminate AP processing. Capital calls via smart contracts automate investor funding. Distributions via tokenized processes reduce transfer agent fees. Every back-office function that involves moving money or recording transactions is a candidate for blockchain migration. XDC becomes the infrastructure layer for institutional fund operations. This creates network effects. As one fund adopts, their portfolio companies benefit from better payroll. Those companies become advocates when acquired by other funds. Auditors and administrators who service multiple funds see the efficiency gains and recommend XDC infrastructure to other clients. Fund of funds and pension allocators evaluating multiple managers prefer funds using efficient operations. Competitive pressure drives adoption across the industry. The total addressable market is enormous. The global private equity industry manages approximately $6 trillion in assets under management. Venture capital adds another trillion. Hedge funds approximately $4 trillion. These funds collectively own tens of thousands of companies employing millions of people. If even 10% of institutional fund operations migrate to tokenized infrastructure over the next decade, that's trillions in transaction volume and billions in operational processes running on blockchain. XDC positioning as the institutional infrastructure for this migration is the strategic play, not competing for DeFi speculation or retail payments, but becoming the backbone of how institutional finance operates behind the scenes. Let me address the risks and what could prevent this from materializing. Risk 1, regulatory uncertainty. Despite XDC's compliance infrastructure, regulations around tokenized financial operations are still evolving. A regulatory crackdown or unfavorable guidance could slow institutional adoption significantly. Risk 2, competitive alternatives. Other institutional blockchains like Corda or enterprise Ethereum solutions could win fund deployments instead of XDC. First mover advantage isn't guaranteed if competitors execute better or offer superior solutions. Risk 3, institutional conservatism. Investment funds are risk-averse. Even with clear operational benefits, decision makers might delay blockchain adoption due to comfort with existing systems or concerns about technology risk. Adoption timelines could stretch longer than projected. Risk 4, technical execution challenges. Blockchain infrastructure must work flawlessly for institutional adoption. Any security breach, downtime, or operational failure would set back adoption significantly. XDC must execute perfectly. And risk 5, the leaked information might be misinterpreted or exaggerated. What appears to be serious evaluation might just be preliminary research that doesn't lead to deployment. The breadcrumbs could be coincidental rather than indicative of coordinated institutional positioning. My assessment: the institutional infrastructure thesis for XDC is strong regardless of whether tokenized payroll specifically materializes. XDC has systematically built compliance tools, custody solutions, institutional partnerships, and RWA frameworks. These position XDC for multiple institutional use cases. Tokenized payroll is one possibility among many, but the convergence of Elliptic integration, Brickkin launch, token terminal partnership, and RWA focus suggests institutions are seriously evaluating XDC for back-office operations. And payroll is the obvious application that delivers clearest return on investment. This is Crypto Journal, and I want to leave you with this. The most valuable blockchain infrastructure won't be the one with the most retail users or the highest DeFi TVL. It will be the one processing institutional operations that nobody sees, but everyone depends on. The payroll systems, the back-office settlements, the audit trails for trillion-dollar funds, the compliance infrastructure for regulated financial institutions. XDC is building exactly this infrastructure. Elliptic compliance for 500 financial institutions. Utila custody for institutional asset management. ISO 20022 compatibility for bank integration. BlackRock and Fidelity funds tokenized on-chain. 21 shares EQP for regulated investor access. Deutsche Telekom running masternodes. Brickkin providing institutional tokenization tools. Token terminal analytics for institutional evaluation. Every piece is in place for institutions to deploy real operations on XDC. Whether that starts with tokenized payroll, securities settlement, trade finance, or another application, the infrastructure is ready. And the breadcrumbs suggest evaluation is happening now in silence under NDA before becoming public knowledge. Those who recognize institutional infrastructure plays before their obvious capture asymmetric returns. Those who wait for CNBC coverage pay significantly higher prices for certainty. The choice is understanding strategic positioning or waiting for mainstream validation. If you found value in this investigative analysis, hit that like button and drop a comment telling me, do you think investment funds will deploy tokenized payroll on XDC? Or is this thesis too speculative? Your perspectives help me understand how people are evaluating these opportunities. Leaked documents suggest investment funds are evaluating XDC for tokenized payrolls. The question isn't whether institutions will eventually tokenize operations. It's which blockchain becomes their infrastructure layer. And XDC is positioning aggressively for exactly this role. See you in the next one.